So what is Supertrend? Supertrend is a trend-following indicator that plots a single line on a chart. When price closes above the line turns green and sits below the price. That's a bullish signal. When price closes beneath the line turns red and sits above the price. That's a bearish signal. That is the entire concept. One line, two colors, buy or sell. It was designed to be simple enough for any trader to use and sophisticated enough to allow for market volatility. It does this by building its bands using ATR, the average true range, which measures how much an asset typically moves over a particular period. The wider the market is swinging, the wider the supertrend bands become. The narrower the market, the tighter the bands. In theory, this makes it adaptive. So how is Supertrend built? It has 4 steps. Step 1, calculate the midpoint of each candle. Just add the high together with the low and divide by 2. Step 2, calculate the ATR over the chosen period. The default is 10. ATR measures the average range between high and lows across those candles. A pure measure of volatility, nothing else. And if you don't know what ATR is, I've covered it in detail in a previous Under the Hood video, which will appear here right now. Step 3, create the basic bands. Basic upper band equals midpoint plus multiplier times ATR. The basic lower band equals the midpoint minus a multiplier times ATR. And the default multiplier is 3. Step 4, adjust the bands based on prior values. This is a step most explanations skip actually. When the line is green, it only ever moves up, not down. It ratchets higher with every candle that closes above it, locking in a higher floor each time. The moment price forces it downward, the line has already flipped red and is now sitting above the price. And when it is red, the line only ever moves down. 2 colors, 2 directions, one way each. That is what creates the smooth stepping behavior that you see on the chart. And that stepping behavior is exactly what makes it function as a trailing stop. So how does traders use it? The mistake most retail traders make is using Supertrend as an entry signal. Green flips buy, red flips sell. But that is not how more experienced traders use it. Supertrend is a directional bias tool. Green means you're only looking for long setups. Red means you're only looking for short setups. The indicator tells you which side of the market to be on. Everything else comes from price action, the charts. JST USDT. With the Supertrend on it. You can find Supertrend, by the way. This one here, Supertrend, built into TradingView. A beautiful uptrend. The green line stepping up perfectly with price, your trailing stop. If you'd used this as a trailing stop, you'd have just ridden the price up to about here, where you'd have got stopped out. So this is the best case scenario for Supertrend. This is the chart they show you in the tutorials. Now let's see what happens when I scroll forward. A quick drop and stopped out again. Just 1 or 2 sharp candles moving down and that trailing stop will get hit. Had you have entered late, you could be out at a loss here. Now that went down not because the trend was ending, but because the volatility on that single candle was enough to breach the band. Now look at the second yellow arrow. Stopped out again. Now let's look at the third yellow arrow, where it flips red. Although it flipped red, price action is moving sideways. Let's let it play just for a second. It flipped green again. So flipping red did not necessarily take it down, did it? Price chopped sideways. Nothing to trade. 2 or 3 times stopped out. That is not a trailing stop. That is a volatility measurement, deciding your fate on a single candle. Next chart. This is Lazio USDT on the 1-day chart. I've put the pulse flow trend. You can see that it's been in a downtrend at this point for 99 days. And you don't need an indicator to tell you that, do you? You just look at the price action. You look at higher time frame market structure. Now let's switch to the 15-minute and put on the Supertrend. Green, red, green, red, green, red. Constantly flipping, constantly telling you to trade. Constantly wrong. The higher time frame has been screaming downtrend for months. And Supertrend on the 15-minute has no idea. It's too busy measuring volatility on individual candles to notice the bigger picture. And that is a fundamental problem. Supertrend sees candles, market structure, sees the truth. Now let's put on the pulse flow recommended stop. Because as you can see, you're constantly stopped out, stopped out, stopped out, stopped out. And this is not the stock market. This is not Forex. This is crypto. So the pulse flow recommended stop here is 3%. Red box if you're going short, green box if you're going long. You would not have been stopped out here. And as this moves forward, this would move with it. So you'd have still been in for that massive move, right? In a market where a single candle can move 1-2% in no time at all, that band gets breached just on noise, not on a trend change, on noise. The trailing stop that Supertrend is used for, and known for, only works when volatility is predictable and contained, and crypto is neither of those things. The ATR on a 15-minute chart is reacting to every spike, every wick, every liquidity sweep. Supertrend has no way of distinguishing between a real trend change and a single aggressive candle. It just measures the movement and flips. In traditional markets with low volatility, it might survive as a trailing stop tool. But in crypto, it gets you stopped out before the trader's even time to breathe. So Supertrend is ATR with a trend flip. ATR was invented by J. Wiles Wilder in 1978 to measure volatility, not trend direction, not trading bias. Volatility. Taking a volatility measurement, multiplying it by an arbitrary number, in this case 3, and using the colour change to determine whether you're in an uptrend or a downtrend is like using a thermometer to decide if it's going to rain. ATR measures something real. It just does not measure what you think it measures. If you want to know whether a market is in an uptrend or a downtrend, open a higher time frame chart. Look at it. Higher highs, higher lows, uptrend. Lower highs, lower lows, downtrend. Your eyes can see market structure in seconds. No indicator required. No ATR calculation. No multiplier. No whipshaws. The only place that Supertrend genuinely earns its keep is as a trailing stop in a stable market like Forex or the stock exchange. But for crypto, no. Because in crypto, the volatility is just way too high. Pulse flow determines trend by using the EMA 50 and the EMA 200 locked to the 4-hour chart. If the EMA 50 is above the EMA 200 on the 4-hour chart, we're in an uptrend. If it's beneath it, we're in a downtrend. And that's a relationship that reflects real market structure rather than a volatility band. It does not flip on every candle, and it does not pretend that sideways is a trend. That's the difference between a volatility tool and a trend tool. So green does not mean uptrend, red does not mean downtrend. It means a volatility threshold was crossed. Open a higher time frame, look at the structure, your eyes already know. Okay, please would you subscribe, like and share. You can watch one of my other videos down here, and I'll catch you in the next one. Bye bye.